Hi, this is Raghi Horner, and welcome to the Identifying Market Trends using the 34 EMA wave. Just want to make sure our audio is up and running. Okay, I think we're good. All right, so thank you again for joining me. Very excited to be discussing this topic because this is probably the most important topic that I teach, most important tool that I have, and definitely the most important distinction that I made early on as a trader that I feel has made the most difference in my trading and analysis. You know, it's interesting. I just returned back from the New York Traders Expo from this past weekend, and what was really interesting to me about the whole thing is there are so many great teachers and traders and so forth that attend these shows and have very good presentations and so forth. And for me, the most important thing isn't necessarily the strategies that I'll eventually use. I mean, obviously, we're very strategy driven, aren't we, in this whole trading community? We want to find different EAs and custom indicators and different approaches, as if the entry strategy is that missing piece of the puzzle that eludes us and prevents us from being successful traders. You know, I don't know that that's really the case. I don't believe it's been the case in my experience. In my experience, the situation is this, that there are plenty of different and very varied ways to try and take pips from the market. If you're curious about the different ways, you know, I would never say fundamentals are better than technicals and price actions better than fundamentals and technicals are better than price. I mean, I would never say that. What's best for anybody is what instills the most confidence. If anybody was attending a past talk I gave here during our IBFX webinar series called the 3 C's, you would know that comprehension plus comprehension plus confirmation equals confidence. All that alliteration ties my tongue up sometimes, but you know, the bottom line is if we don't understand a particular approach, there's no way that we can go about testing it out in the market. And if we can't test it out in the market, how are we going to learn? How are we going to get any confidence in, you know, being able to use it with any kind of consistency? Okay. So in terms of, again, strategies is about what makes sense to you, not on this quest to find that one great, perfect strategy. I don't think that exists. The reason I don't think there is just one single strategy that's going to answer all your questions and so forth is because a couple of things. Number one, I don't know how many of you have read The Market Wizards and The New Market Wizards by Jack Schwager. Has anybody read those here in the room tonight? And the way you spell Jack is, Jack Schwager is obviously Jack, then S-C-H-W-A-G-E-R. And he wrote The Market Wizards and The New Market Wizards. Okay, it's 2 books. And I mention these books because in these books he interviews a number of different traders, very successful, proven traders. And he also goes about taking the next step, which is to interview these people, which at the time when this was written, these weren't people that were really interested in being public or known, okay? They very quietly did what they did for a living and did it very successfully. So he got these interviews, and the one thing that you'll learn, and this is not a strategy book. It's not about how they trade in terms of the details of their entries. They weren't sharing that. But it was the overall style that they used. And what was so interesting was that in the book, there were people with so many different types of strategies, styles, I should say, and therefore different strategies. Systems traders, discretionary traders, pit traders, back office traders, technicians, chartists, tape readers, you know. They ran the gamut of all the different types of categories under which the strategies would fall. So it wasn't that the entries were necessarily what made them successful, having that one magic entry. It really was about understanding what works for them. There their trade management and namely their risk management really was very, very similar. In other words, if you're wrong, know where you're wrong and take your hit. That was definitely a common thread that ran through all of their interviews. If you have a strategy, you must know when your strategy is wrong and take your hit over and over and over again. Pit trader, back office trader, technician, chartist, system trader, whatever. That was definitely the common thread. I bring all this up, and this is how, to me, it ties up into the identifying market trends through using the 34 EMA wave, because the actual process is very straightforward and simple. I mean, it's a 15-minute discussion if you really want to be, kind of cut and dry about it. It's the why we do this, because if I don't impress upon you why you do it, it's going to be easy to blow off. It's going to be easy to get lulled into all the excitement of the different strategy, and sometimes forgetting that even if a particular strategy triggers a trade, it may not be happening in the correct market environment. Again, that's my opinion about the way I trade. It's got to be a combination of the trigger occurring within the correct market environment. Okay? So having said all that, hopefully I've kind of piqued your interest as to why this is so important. And to kind of bring this full circle to New York, I met this gentleman at the Interbank FX booth. We were situated in such a way on the 6th floor that as people traveled to and from the exhibitions and to the breakout sessions, they'd have to pass us at some point in the hallway. And it was a really good location because people oftentimes would stop and take a look at our booth. We had all sorts of computers, and we had the mini challenge running. So there was a lot of excitement. And one gentleman said, "Teach me something new." And I thought, wow, what an interesting question. So I talked to him about what I'm going to be talking to you about here tonight, which is all the strategies that you may know, and in his case, the strategy that he had learned during the expo, during his time there, listening to all sorts of different speakers and visiting different booths and so forth. The bottom line is you have to know when to apply each one of those strategies, because the greatest strategy in the world applied to the wrong market environment will not yield you the results that you're looking for. That's been my experience. You know, a hammer is an unbelievably powerful tool. So is a screwdriver. Nails are absolutely essential in building something. So are nails. So are screws. But if I've got a bag full of screws and a hammer, it's not going to do me any good. Perfectly good tools, wrong combination. For us, that equates to wrong environment. So hopefully that's going to give you a visual. So it's not a matter of my belittling any other approaches out there or tools or indicators or anything. It's a matter really of saying tonight's talk isn't about entry strategies. Okay, we've got plenty of past webinars about those. I discussed those in detail at the IBFX Daily Trading Edge. Okay. So there's no shortage of my discussing the details of my entries. Tonight is really about how do you take the entries and make sure you're applying them. And this includes indicators, by the way, and you're applying them in the right market. That is really the discussion that I think every trader hopefully has. I was lucky enough to be exposed to this concept early on, courtesy of Mr. Charles Dow. And you know, it's my hope that this will impress upon you to go back and look at your strategies and ask yourself, is it one of 4 market trends? So let's talk about the market trends right now, for those of you that have never heard of it. Market trends are straight from Charles Dow. And what I'm going to do here for tonight, and if you've joined me in the past, you know I like to do this kind of active note-taking type presentation. I find PowerPoint not only dull for me, but dull for you. And therefore, what I like to do is just kind of go to a Word document and kind of make notes as we're talking. Okay, so I'm going to jump on over to the blank Word doc, and we're going to go through the first concept, which is the market trends themselves. You know, what is a market trend? You know, what am I talking about when I'm referring to this idea of market trends? Again, it's Dow theory, which was coined posthumously. Charles Dow never called, or I don't even know that he ever envisioned this idea of Dow theory. He didn't seem like a pompous enough man to name something after himself. I don't know. I've never done that, and I'm not going to name something after myself. In fact, all the tools that I developed, I never ever would have even dreamed that at some point in time I'd be sitting in a hall or in a webinar or in a book, in front of, writing for a book, naming these tools. Maybe then I would have named them after myself. Who knows? But I named them after things that visually mean something to me, and that I found memorable. Okay, Dow theory encompasses a lot of different topics. Okay, market trends is but one of them. When you talk about market trends, another way you can discuss this topic is really to say psychology of the market. There's two types of psychology. Okay, there's external, which I think is absolutely invaluable. Okay, and then there's internal. Now, I'm not going to say that internal isn't important, but it's one of those topics that becomes just this all-encompassing, never-ending, internal, your inner child brouhaha, where it just never ends. It just becomes this just this very self-consuming, what's going on in my mind, touchy-feely thing. If you can't tell by my tone, I'm really searching for polite words to say that internal psychology in a lot of ways is absolutely ridiculous. I really am quite tired of reading about internal psychology, how, I'm processing the market. There are very valid points about internal psychology, but really the main goal, however it is you get there, okay, don't get lost in the muckety-muck of internal psychology. It's very easy to get stuck up in that cycle of how you're feeling about the market. Okay, the bottom line is, if you don't understand your process and you haven't taken the time to confirm it, you're never going to get confident in it. And internal psychology really is that simple. Okay, but and you can hear me getting punchy about this because I find a lot of people milking this topic to no end, and it really does bother me a lot. Okay, it's one of those topics that can be milked because it's never ending. Okay, it's one of those topics where we're never going to find the answer to the question. It's just like our own lives. That question of who am I and what am I doing here will never be answered. It's a continual search. Well, we're going to continue on with becoming better versions of a trader, but the bottom line is internal psychology is to get ourselves out of the way. Okay, that is the main goal of internal psychology. Get ourselves, and really, I should say specifically, our own biases and our own hang-ups out of the way. That is the job of internal psychology. So really, what we're talking about here today is external psychology. The psychology of the market is external psychology. I want to shut my own brain up. I want to shut that little voice whispering in my brain up to the point where I can listen to what the market is saying. Okay, I don't want to be so self-indulgent that I'm so consumed in my own biases and problems that I forget that my job as a trader isn't to coddle myself. It's to figure out what the market is telling me. So internal psychology is important to shut up that pig in the head, no doubt. And I apologize in some ways for the tone, but of this portion of our talk, but I cannot stress enough. At some point, this internal psychology thing just has gotten completely out of hand. Someone needs to tell everybody that really the main job of internal psychology is to get ourselves out of the way, get ourselves confident in the tools that we have. Confidence must be earned. Confidence is earned by study and by testing. Everybody's got a different learning curve. Everybody's got a different confidence curve. How we get to that confidence level is individual to all of us, which is why I can never tell anybody and say, oh, you'll learn how to trade in 12 weeks. We all come with different baggage. If you were a losing trader for a long time, it's going to be more difficult for you to become confident. If you're a brand new trader, in a lot of ways, you'll get your confidence too quick because you don't know any better and the market hasn't slapped you around a while. you know. So it's just a very interesting process. It's a very individual process. But again, get ourselves, and that means our bias and our hang-ups, out of the way. Charles Dow theory, like I mentioned, was coined posthumously. And he talked about 3 trends, mostly. Markup, and in no particular order, distribution and accumulation. Now, of course, stocks, which is what Charles Dow cut his teeth on, stocks have a bullish bias. So he didn't really talk about markdown or downtrends. Okay, we do as Forex traders. We know the market goes up, we know the market goes down. We can take advantage of both. Okay, so in all due respect to Mr. Dow, I include markdown. And so do a lot of traders. That's not just me. Okay, so if I were to take those 4 market trends of Dow theory and assign kind of a human characteristic to it, okay, I would say that markup is greed, distribution is confusion, accumulation is boredom or kind of a waiting process, and markdown is fear. Okay? So again, that's the psychology behind the price movement, and we know that different psychologies have different characteristics. Well, going back to that one magic entry, there's no such thing as the one magic entry because I'm dealing with 4 market or psychology types. Okay, there's 4. So there's no one magic entry. It's going to be really 4 entries. And they don't have to really even be all that magic. They just have to be applied in the right way at the right time, in my opinion. So that comes back to, how do I identify or determine the psychology of the market? Now, for me, this answer was the 34 EMA wave. Now, to make a long story short, the number 34 is a Fibonacci number. And I'm a big fan of Fibonacci, but that's definitely a talk for another time because I could go on for that for about 18 days. It's a Fibonacci number. The wave is comprised of the 34 period exponential moving average. You set one on the high, you set one on the low, you set one on the close. So it is 3 individual moving averages for those of you that are unfamiliar with it. Now, I will mention that we can simplify this entire process, and if you head on over to ibfx.com/tools and then over to the grab, you can actually get the plugin that will work on your MT4 platform. Okay? And that's very cool because now you don't have to worry about overlaying those moving averages, and you can actually have my other equally cool tool called Grab Candles. Okay? So let me show you that link that I just typed in. So if you head on over to that link, this is what you'll see, number 1. And what it will give you is the download that will allow you to have the color-coded candles that you're going to see shortly. Okay? And the wave, the 34 EMA wave. So here you can see the green, the blue, and the red of the 34 EMA wave. All right? So identifying the market psychology, the market trend, is the first step before you use any strategy that you've learned. One that I've taught you, chart patterns, one that you've recently learned, whatever it is. That's the first step, which means that if you have a basket of strategies, you must know whether they are trend following, whether they are trend reversal strategies, momentum, swing. You know, I'll outline these back in our notes here in just a moment. Okay? So again, the process really must be at some point, how do I get the confidence in what I'm doing? And like I said, the formula in terms of what I think is, the inner psychology is comprehension, which is, do you understand the tools and the strategy that you're using? Great. You have to take the time to learn them. Then you have to take the time to go into the market in demo or in a micro or mini account and confirm that you have really absorbed what you've been trying to learn. In other words, prove to yourself. Go out there and test it. If you've learned properly, and if you then have the success in the market applying what you've learned, slowly, over time, you will have this feeling, and that feeling is confidence. I don't know that any of us are born confident. I don't know that I was. I don't know that I was born confident in my trading skills. I earned it. I earned it, one page of a book at a time, one course at a time, one seminar at a time, one trade at a time, one analysis at a time. It was over time that I learned. And the markets are not designed to make or keep you confident. So if there is a capital, your most valuable capital isn't necessarily, in my opinion, money. It is your confidence. Okay? So if you've taken the time to build it, you must protect it. You must protect it, because confidence is everything to me. If I blew up tomorrow, I could deliver pizzas, mow lawns, whatever it took, borrow, beg, whatever, and I could come up with a grub stake again. I think any great trader will tell you, especially if you read the Market Wizards. Every one of those traders said, look, I don't care what it is. I could find a way to get the money again. I could find a way to get a grub stake again. But if I've lost my confidence, if I've lost the ability to look at the market and feel that I have an edge, that I understand what's going on, doesn't matter how big your grub stake is. Which is why it's kind of a funny thing where new traders feel that if they're super ridiculously capitalized, that somehow guarantees success. It doesn't. Is it tougher to start off as a short-funded trader? Certainly. I won't deny that. But it doesn't necessarily mean you're guaranteeing success by having a lot of capital to burn through. Okay? So there's your inner psychology formula. Hopefully I've stressed how important it is to understand the confidence. Again, get your inner psychology out of the way so you can focus on the psychology that really matters, which is external. And the external psychology, it goes back to that Dow theory, having those human characteristics, markup or greed, distribution or confusion, accumulation or boredom or waiting, and then mark down, which is fear. Right? Now, how do we go about identifying that? Well, we overlay some tools on our charts. We overlay the 34 period EMA on the high, the low, the close, and we can go over to the Interbank FX website and download the tools so that you have the wave overlaid on your charts automatically, which is nice. Not to mention my grab candles, my green, red, and blue. Okay? So, in terms of now, let's taking the next step, okay? Let's go to the charts. And I don't know how many of you follow me over at the Daily Trading Edge or any one of the number of sites that I offer content for. I don't know how many of you have been to those sites, but hopefully you've checked them out at some point because, in the interest of what I know Interbank FX does, and in the interest of what I've always felt is of the utmost importance is this idea of being as transparent about my process as possible, okay, which is why you'll find me on so many websites and videos and so forth. That's just a big thing for me. It's very important to me to even on Twitter. I don't know how many follow me on Twitter. I'm a big fan of not talking about the past. I'm a big fan of talking about what I'm going to do and what I am doing, and being very timely about it and being very transparent about it and being specific about price and sharing charts and so forth. So if you follow me on Twitter or even on Facebook, you know that I try to do that as best I can. So once you've laid the wave or using Grab and the 34 EMA wave as the automated download will create for you, you'll get a chart that pretty much looks a lot like this. You'll have 3 moving averages, and then you'll have your candles color-coded. Okay? There's a number of things you can get from this. And again, with remembering that today's topic is market trends, okay? Again, it's not about strategies tonight. It's not about entry strategies tonight. It's about you looking at the entry strategies that you do have and asking yourself, let's go back over to our note-taking screen here, and ask yourself, the strategies that you do have, are they trend following? Are they breakdown? Trend reversal? Or are they what I call inside the range? Okay? In my mind, the market can basically go up, and if somebody knows of a different direction, let me know. It can go down. Okay? It can go sideways. I don't know of any other way the market can go. Up, down, or sideways, right? So if I know the market can go up, down, or sideways, I know that there's trends within the up or down trend. I know if there's trends, there must be reversals, right? If the market can go sideways, if it's a wide range, inside the range, expecting exhaustions is one way. And then if there's another type of sideways market, that's the narrow sideways market, okay? I can wait for breakouts or breakdowns. Some people call this momentum. I'll call it MOMO. You hear me talk about a MOMO trade? That's momentum, waiting for the market to reveal what its next choice of direction is going to be. All right? So in terms of the 4 things the market can do, the 4 trends that the market has, according to the Dow theory, right? That's where I start looking for the angles of my 34 EMA wave. Okay? So before we get into the wave reading, and the wave really has a couple of components as far as reading it properly. Okay, so let's get back over to our note-taking here, and then we can get right into the charts. It's not a difficult thing, gang. It really isn't. The look back or market memory is a key component to using the wave, because we need to use it in a consistent and really the proper perspective. So in a consistent way with the proper perspective. And for me, it's very time frame specific. So my preferred time frames are typically the 5, 15, 30, 60, 240, and daily. Now, which of those I'll trade has a lot to do with the clarity of the psychology and the market trend and so forth, and we've discussed that, market clarity and so forth, in other talks, and I'll have to leave it at that on that topic. But suffice to say, part of the choice as to which time frame I will utilize has to do with directional bias. We talked about directional bias this month. Okay, that's a big part of which time frame. You know, what is the daily market psychology? And a lot will have to do with your own risk tolerance. For me, I assign a certain amount of risk. You know, to me, risk is market exposure. Okay? If you're in the market, you're in a risk environment, period. Okay? In the market means risk to me. Okay? So if I talk about risk, you're in the market. you're open to risk. So the longer, so using that thinking, the longer you're in a trade, you know, it's funny. It's probably easy. You think it would be very easy to type and talk at the same time. It's terribly difficult, actually. The longer you're in a trade, all right, the more risk you are exposed to because you have a live open trade. Open trade means risk. That's just always been my approach. So with that thinking, again, shorter term time frames typically mean less risk in this the way that I'm defining it. And therefore longer term time frames mean more risk. Now, along with the higher degree of risk, I mean, I guess there's a certain amount of discussion of potential higher reward, but let's just focus on risk for now. Okay. So, you know, there are a number of things that will have you considering which time frame is right for you. You know, the daily is important, not necessarily just from a trading perspective, but again, if you've been reading the Daily Trading Edge and anything that I've been talking about or writing about in the last 3 months, directional bias has been coming out of my mouth on a very consistent basis. So if you have not yet heard me discuss this topic, I would highly recommend that you take the time to do so because it's a big part of trade selection. Okay? Big part of trade selection as far as I'm concerned. Okay? And, you know, as far as understanding directional bias, and if you Google, by the way, directional bias, I believe there'll be some articles that I've written about it, but for me, the directional bias is what is the daily telling you, the daily being the most psychologically significant time frame, in my opinion. But let me get back to the market look back and that proper perspective, okay? So for that 5-minute chart, when I'm looking at the chart, I want to remember that there's a certain amount of price action, data, that I need to have on the chart view, okay? So if I have a 5-minute chart, relevant price action probably doesn't really pertain to a week ago on a very, very short-term time frame like a 5-minute. It's really a 1 to 2 day relevance. So I want to keep about 1 to 2 days in my chart view. Okay, I think a lot of traders don't consider what it is they've populated their chart with. They talk about indicators and patterns and all these other things, but they don't think about how much data they actually have on their charts. It's usually not a conscious thought. I've seen that so many times with traders. It's just not a conscious thought. So what I'm telling you here is it really must be a conscious thought. Okay? All right. The other thing to consider, and just bear with me one moment. Where was I here? Okay, so 5-minute, it's 15-minute. Again, still short term, but you know what's relevant? I think about 3 to 5 days is relevant. Okay, 30-minute. I think what's relevant is about 5 to 10 days. 60. I try to keep that as close as I can to about 2 weeks. 240-minute. I end up somewhere about 4 to sometimes 6, even 8 weeks, so 1 to 2 months sometimes. Okay, so really 4 to 6, sometimes 8 weeks, and then finally the daily is 1 year. In other words, when I'm making some sort of assessment about where the price has been and trends and touch points and significant highs and lows, this market memory or market look back is a perspective from which I begin looking at the market. In other words, I squeeze that data in to my chart view as the first move as far as analyzing what that time frame is trying to tell me. So that means at some point I have to squeeze this data in. I don't have to leave it there, but I got to start there. And it's from this look back that I will take what I call a clock angle reading of the wave. Okay, from the look back or market memory, whatever you want to call it. I refer to them both kind of interchangeably. So if I'm talking about market memory, I mean look back, and if I say look back, I mean market memory. I kind of use them interchangeably. So in terms of where you start, and again, it's not just about the angle of the wave, but it's about drawing trend lines. It's about finding significant highs and lows. It's about the rallies, okay, the recent rallies and sell-offs. There's just so many things that you need to be determining. If I'm not looking at enough data, I could be missing out on key levels on the chart. That's just a big part of what I think happens to new and experienced traders alike. New traders tend to look at not enough data, while experienced traders actually look at too much. I think there is such a thing as looking at too much data, because when you get too far beyond the market memory, let's talk about the other end of it. When you start including too much data, more is not better. More simply becomes sometimes irrelevant or less impactful. Okay, so now we're talking about how much data you put in that box, in that chart, in order to start your analysis. And again, as it pertains to our discussion here, it's about making sure you keep the wave, the 34 EMA wave, in proper perspective. Okay? And that's a big part of using it correctly. Okay, so having said all that, and coming back to the point where it is about identifying which of the 4 market trends we are dealing with, okay? So once I've done this, I've squeezed in the market data, I've got my 34 EMA wave and even my grab candles on the chart, what do I want to do at that point? All right, well then the next step is look at the clock angle. Now I use clock angles because I think we as human beings have come to recognize the angle of 12, 1, 2, 3, 4, 5, 6 so well that they make watches and clocks without numbers. We know what 2 o'clock looks like so well that we don't even need numbers on the clock or watch face, and we know that's a 2 o'clock angle. Okay? So the angle at which the 3 moving average lines are traveling on the hard right edge of the chart dictate the market trend. So if I'm looking right now in the daily dollar yen, which is what this chart is, notice that it's not really steep enough to be a trend. I mean, this was a nice downtrend we had here, obviously. Very short-term uptrend here for a while. If it's traveling either higher or lower, I want to know if it's traveling steep enough in an upward angle to be considered 12 to 2 o'clock. Okay? If it's heading higher, lower, okay, so higher at 12 to 2, lower, I'm looking to see if it's traveling at 4 to 6 o'clock. If it is, if I feel that it is, I could be looking at a trend. Okay? Now, are there other ways to confirm whether or not I think the market's trending? Sure. That's where the grab candles come in. You know, a trend is built upon the organization of sentiment and momentum. So if I know I'm dealing with a certain amount of Bullish sentiment, if it organizes, it becomes momentum. And if that momentum organizes, continues to be bullish, I could be looking at a trend. It's really that simple for me. That's really that simple in my mind. So with that having been said, sentiment plus momentum equals trend. Well, sentiment and momentum in my mind can be measured by the grab candles. So I call them grab because grab stands for green, red, and blue. So grab, G-R-A-B. When they're plotting red, it simply means that prices have closed below the 34-period EMA on the low. When they're plotting blue, that means they've closed within the area between the 34 EMA low and the 34 EMA high. And when the candles are green, they're closing above the 34-period EMA high. And I use that 34-period high-low close to determine not only the angle of the market in terms of market trends, but also whether or not we're kind of strong or weak or neutral, bullish, bearish, or neutral. When there's a lot of red candles, I'm probably looking at a downtrend. When there's a lot of green candles, I'm probably looking at an uptrend. What's a lot? Again, that's subjective. But the more you have, the more likely you are dealing with the continuation of that sentiment and momentum and possibly trend. I gauge the trend, of course, by the wave. I gauge sentiment and momentum with the grab candles. When you have the grab candles going a lot of blue, just blue, 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 one after the other, you're likely looking at a very quiet sideways market, could be accumulation. When you see the grab candles not staying green for very long, not staying red for very long, and also included with blue, you're probably looking at distribution. The market's able to get above or below the wave, but not continue in that direction because it keeps coming back to the blue neutral candle. So again, it's a matter of organization of that sentiment, that organization of momentum. All right. For our purposes here, really our focus is on the 34 EMA wave. And that means, again, I'm focused on the clock angle. So a mark up or an uptrend or the greed market is 12 to 2 o'clock. A mark down or a downtrend or the fear market is 4 to 6 o'clock. Accumulation, which is that board or waiting market, is we'll see a lot of blue, right? Mostly blue, predominantly blue. And the wave, more importantly, will flatten out to what I call a 3 o'clock angle. In other words, just flat, pointing at 3. Therefore, distribution, which is a market trend that we've been seeing quite a bit of. We're seeing it right now on the Euro-US dollar. We're seeing it right now on the dollar-yen. We've seen it, I believe, right now on the Aussie. There's a number of markets that on the daily chart are moving in a sideways range. Okay, sideways volatile range of distribution. So when we have a market that is moving in that manner, okay, I mentioned the dollar-yen was doing it on the daily. When we have a market moving in that manner, it's really easier to discover it by a process of elimination. In other words, when I'm finding a distribution market trend, it's really because the wave was not steep enough to be a mark up or mark down. It was not flat enough to be accumulation. And what I'm left with is either a transitional market or distribution. And I talked about this today at the Daily Trading Edge at IBFX. If you take a look at the post that was put up today called Distribution Ranges on the Daily and Intraday Trends. And I talk about a lot about distribution on today's update. So again, distribution is a process really of finding a 2 to 4 o'clock angle, but it's really more about the market not being trending and then not being flat enough to be accumulation. What you're left with, again, is a transitional or distribution market trend. All right? So in terms of the four characteristics or personalities of the market, okay, again, you have to take, and is there, by the way, is there subjectivity here? Absolutely. You know, I don't want you thinking that this tool is just black and white, easy peasy, lemon squeezy. Not even close. And there is absolutely some subjectivity, but by using the market look back in memory and trying to take the clock angle reading from a very consistent amount of data over and over again on the same time frame, my hope is that a certain amount of consistency will arise from that, a certain amount of reliance on a certain amount of data will offer the consistency of recognizing these clock angles with ease. That's my hope anyway. All right. So again, it's all about looking at, when you're trying to determine the market trend, it's all about looking at the wave. Now, some people ask, well, why couldn't I just look at the candles? That's true. You know, I think that, you know, why couldn't I just draw a trend line? And that's true, but I find trend lines lag very much. It lag a great deal compared to what the wave indicates. I find that when the market's transitional, price itself can be misleading as far as the trend. The subtle shifts in price oftentimes are much easier to recognize with the three lines of the wave than they are to look at price. Now, I'm not against naked charts. There's a big movement for just price action and simple charts and only charts, but to me, you know, a nice road is great, but having lines on the road helps even better. Helps organize the traffic, right? Nice yellow and white lines on the road. This is kind of like my lines on the road, all right? A nice road is great, but having lines there definitely helps. It's kind of like my lines on the road. Hopefully that kind of makes sense. All right, so that is how you use the 34 EMA wave to determine the market trend. Now what, right? Okay, Raghee, great. Now what? Okay, so what's step 2, right? What's step 2? And what I'll do to discuss step 2 is I see there's a couple questions about what market trend a few different pairs are in different time frames. So let's go ahead and use some of these questions that are popping up on the board to address the next step, which is what's next? Okay, Raghee, we found the market trend. Now what? Okay, so I have one question here. It's popped up on the board regarding the 30-minute dollar Swissy. Now, realize the market lookbacks that I gave you, they won't always fit perfectly within the time axis of the chart. You know, some charts will jump a great deal. I would rather you get as close as you can, but if you have to err on the side of too much, you know, being over versus being under on the market look back, I'd rather you be over. Okay? So if I'm looking at the dollar Swissy 30-minute, I know it's about 5 to 10 days. I'm looking at February 17th to February 24th. So I know I'm looking about, and that's 5 to 10 trading days, 1 to 2 weeks. So I'm looking at about 10 days here. Not quite the high of the market look back, not quite the low of the market look back. It's somewhere in the middle. This is fine. You can go one more, but notice if I go one more notch, now I'm looking at about 2 weeks. That's fine. That's fine too. What is the angle of the wave within these two look backs? You know, whether it be the shorter 10-day one or whether it be the steeper one. Notice the more data, it does add a certain amount of a different view, but again, look at the angle here, the hard right edge. I think regardless of which view you're looking at, when you look at that hard right edge, it's very similar. Okay, and we are pointing downward, I believe, in what could be considered a 4 to 6 o'clock angle. Not the steepest one I've ever seen, but I think there's a pretty good argument here that the Swissy on the 30-minute is in a 4 to 6 o'clock angle. And if that's the case, what I'm looking for are opportunities to short into the downtrend. Now, I think you have to also, and this comes to our conversation from last week, which was directional bias, I think you have to respect the fact that we've just broken to brand new lows. And sure, there could be more of a push downward with the bearish momentum, but just be very cautious here. Okay, yes, we are below 9,300. We're approaching 9,200, but just be cautious here, because if you're looking at a continuation lower of the 30-minute chart, there's got to be room to make those fresh lower lows in order to realize some sort of follow-through. So yes, I believe it's a markdown market trend. I would just be a little on the cautious side about executing any kind of swing short. Okay. Could we be transitioning into distribution? I don't think we're there yet. This could be a transitional market. We'll probably know by the time the Asian session rolls around, because if we don't make lower lows, the past highs we saw throughout today's session past lows we saw throughout today's session could be putting in a near-term intraday floor off which we could transition out of the downtrend, which again is not very steep and not, it's not the steepest 4 to 6 o'clock downtrend I've ever seen in my life. Not very steep, but it could be enough in terms of the support that's been created. If we kind of continue to bounce off those lows, there's a good chance we could transition out of the markdown, the shallow markdown, into distribution. So what does that mean? Well, typically I'd look for swing shorts. And if you've been watching me for any length of time or reading the Daily Trading Edge, you know how to set up a swing short. So we need to be cautious about that. A distribution market would then mean I'd be looking at the floors as a potential exhaustion level to get long. Okay, and again, today really wasn't about entries, but the next step is trying to determine what type of strategy. So I'm saying here that I'm kind of hesitant to look for some sort of trend following short, and I may start to consider some sort of inside the range buy, in other words, some sort of exhaustive buying approach. Okay, that's what I would see. That's what I would look to do according to what I see on the 30-minute dollar Swissy. Okay, let's look at another chart here. That would be the Daily Canada. Let's take a look at the Daily Canada. All right, Daily Canada. Now, since we're looking at the daily, we're also talking about directional bias, and that directional bias has far more impact than just the daily. And if you watched last week's, I believe it was last week's discussion, we talked about directional bias. And on the daily dollar Canada, again, what do we need to do? 1 year, right? 1 year look back. I'm looking at about April of 2010 right now to February. That's about 10 months. Okay. If I squeeze in a little bit more, I'm way over. I'm into like May of 2009. But look at both, okay, whether it be the April or the May, and I think you get the same result, okay, which is it's heading lower, but it's not a very strong mark down, okay? And there's probably more bearishness than neutral, right? How do I know that? How would I even say that? Well, if you look at the most recent price action, we do have some sprinklings of the blue candles and neutral candles in there, but I'd say it's predominantly red. But there's enough blue candles to show some hesitancy from the bears, to show some strength from the bulls. So this is by no means a strong markdown cycle. It's by no means an organized distribution market trend either, and it is a market that continues to bounce off some near-term support from about the last, I don't know, 4 or 5 days, 4 or 5 trading sessions. So when you see a lot of red mixed in with blue, remember that, sure, you have some bearishness, but there's enough neutral market sentiment to consider that the markdown really isn't all that strong. What does that mean for our trades? Well, if you're trying to find or take advantage of some sort of weakness on the dollar Canada, if you expect the Canadian dollar to continue to gain on the U.S. dollar, perhaps your best bet would be to look at some of the markdown trends that are currently on the 30 or the 60-minute time frame. In other words, you wait for a bounce and short into it. I will say that the crude oil market pulled back below 100. Okay, crude oil and the Canada have a connection, but it really hasn't been that impactful since crude oil really started taking off and broke out of its range. So I wouldn't put too much stock in the the rally in crude oil right now as far as helping the loonie rally over the dollar. Okay, the likelihood for lower lows here, questionable based upon the daily's directional bias. So perhaps waiting for corrections in the 30 and 60-minute time frames, intraday time frames, that might be a better bet as far as taking advantage of any expectations of lower lows. Okay? And again, the daily chart is not really in a clean markdown, although there is certainly much more bearishness than any bullishness whatsoever. But there's enough neutral here to quell that negative sentiment. Okay? All right. So another chart that I've been watching, which could be interesting for any of you that are also watching it, is that Euro-US dollar. The Euro-US dollar is trying, in my mind, to pull up to a 12 to 2 o'clock. Okay? It's trying. But at the same time, the transition to a 12 to 2 is relatively recent. It's resumption of what could be an uptrend. So for me to really say that we're looking at a markup trend, I think taking out this recent high up here at 38.60 is key. You know, finding some buying support above 3,800 is key to any kind of continuation higher on the Euro-US dollar. And for now, I'm actually expecting the possibility for exhaustion around 38.60. So I think we're in an area where I think some traders will position themselves at shorts. And I think there's a chance here that at this area, some traders will be considering looking at an overbought fiber, overbought Euro-US dollar, and considering shorts. I don't think that's out of the question whatsoever. If it is a new markup, it's transitional, and transitional markets have sometimes a tendency to exhaust. Just be careful. If we can find any kind of momentum or buying support above that high, at 38.60 high, be careful. You don't want to be on the wrong side of the momentum. Okay? A market right now that's just super easy to determine the angle on right now and see the trend is the cable. And I've been talking about the cable continuously, pretty much anywhere anyone will let me, where I continue to discuss the trend following swing buys that are occurring. However, I think it's very important to note that the swing buys that I talked about back here in mid to late January, again in late to early, I should say early February, we're squeezing up against the 6,200 level. Okay? I shouldn't say 6,200 because it's a little higher than that. But we're squeezing up against this intraday, I'm sorry, intraday, end of day double top. It's a double top up here. So basically as the wave moves up, okay, we're starting to basically be in a situation where along this area we have a ceiling, but then at the same time we have this support, and eventually we're just going to find ourselves running out of room, where even if we get that correction, how much room is there to move until something's got to give? So either the support's going to give or the resistance is going to give, but something's going to give because we're basically being squeezed into this area. Okay? So that's something to consider on the cable. These are valid swing buys, but we're running out of room to move as that ceiling just looms overhead. Okay? So again, hopefully today's discussion kind of opened your eyes to the fact that it's not just about entry strategies, it's about when you apply them. Okay, so this is by far, I think, the most impactful thing on, again, my trading. It's the one thing that I definitely want everybody to understand and learn, this concept, because, again, it's not about entries. It's about when you use your strategy. What type of indicators are you using? You know, what's the justification for following a trend if you can't find a way to identify a trend in the first place? What's the justification for breakout trades and breakdown trades if you can't identify that sideways price movement to begin with, under which condition you could take advantage of momentum? Okay, so as always, I am very thankful that you took some time out of your day to learn something about the markets. Thank you for allowing me to be your teacher for this past hour. And hopefully we'll meet again as we do each Thursday here at the IBFX chat room. If you have requests for topics or any feedback, by all means, I believe there's an email address you can send that to. You showed that information from the email you got that gave you the access to the room. We're all about feedback. We're all about trying to get you the tools you need to build that confidence, right? So again, whatever part I can play in that, please don't hesitate to ask. Thanks as always, and I will see you all next week, okay? All right, again, thank you for your time.